Hey everyone, welcome back to my channel. Today, we are diving into the world of trading and investing, and we have got something special for you. We are going to explore a comprehensive set of financial metrics that can help you make informed decisions when it comes to picking stock or maybe anything, like whenever you want to just go through the different companies analysis or even the company you're working for currently. You just want to know what exactly going in my company, how I can do the valuation of my company, whether I'm in the right organization or not, or overall the broader set of industries or anything you want to look into. So this is going to help you way better than others. So here I'm not going to use any catchy lines like other YouTubers and all those things, because I'm not exactly a YouTuber. This is my try to give you better understanding about the overall market and whatever I have learned as of now. So just share with you. This channel is all about it. If you want to learn more about different things, maybe including any specific stock market related things or maybe education related things, please do subscribe and like, share with your friends, because I'm quite beginner into this YouTube phase. So this will help me to grab more attention towards the market size and capture more. So it is gonna just help me to get connected and recognize. So what next now? So grab your notebooks and hit that like button and let's get started. So this chapter is all about understanding fundamental analysis. And there we have 18 specific parameters of financial metrics which I'm going to talk about. But apart from that, I'm going to tell you in between like maybe one to two extra. So technically it will be 20. And remember one thing. So what I have done is purposely I have changed the number, like specific format, and maybe uh, not all the important ones are in the starting. So it's mix and match. So you have to stay tuned to go through each and every one, because some people they just like, just give me top five and I'll go through it. I won't, because it's not easy and it's not always right to just go with the five specific metrics and decide, okay, this company looks fine. No, not always. And this specific video is not about management analysis or anything. This is all about pure just based on the numbers majorly. And remember one thing, thorough research and the analysis are essential for success in the market. So let's get started. The first one, debt to equity ratio. What it indicates? This ratio compares a company's total debt to its total equity. Already I have explained to you what is equity. So equity is all about the shares and all the stock or whatever you call it, and indicating the proportion of financing provided by like creditors versus shareholders. Simple. If you own any company, or if you have even bought any company stock or anything, so for that matter you should know how many specific equity the creditors are providing and how many our shareholders are providing. And a ratio below 0.5 suggests that the companies relies more on equity financing than debt financing. That means the companies have lower risk. Obviously if you have lower debt compared to equity, that's good. You can see the formula almost all over the slides. You'll find the formulas, so don't worry about it. So one more thing I want to mention it here, that not all good companies may have debt to equity ratio below 0.5. Why? Because it's all about the sector as well. Let's say if company is in specific slow growth sector or where the debt is very unnecessary factor, so in some certain scenarios you have to avoid debt to equity ratio, even though if it's not zero point 0.5 or less than that. So now what I'm going to tell you next, before starting the next ratio, I want to tell you one more thing. Even though I'm going to tell you 18 to 20 formulas or the metrics, you don't need to use all of them, or all of them not needed to be like, cross and pass through each and every line. So what you need is Out of 18 to 20, even though if company is crossing like more than 12 points or something like this, it's good enough unless and until the other parameters are not at worst. That's it. Simple. Let's hit into the next one. The next one is interest coverage ratio. It measures a company's ability to pay interest expenses on its outstanding debt. Simple, very simple. This ratio, it should be, most likely it should be, indicates that the greater generate, like if it's more than 3, that means company generates sufficient operating income to cover its interest expenses. Simple. What it signifies, it's financial stability and a reduced risk of default in the future. Easy? Yep. And there you got a formula. Interest coverage ratio is equal to EBIT divided by interest expenses. Simple. Next one. Yeah. The current ratio. It's not the electricity type of current. It's just normal current ratio. What current means? Current means today, or maybe short term, maybe 3 months, 6 months, 1 year, something like this. So that's what it's about. The current ratio assesses a company's short term liquidity by comparing its current asset to its current liability. A ratio above 1.25 suggests that the company has more current asset than current liabilities, indicating its ability to meet short term obligation comfortably. Now, here is one trick. Before going next form, before going to next financial metric, let me tell you there is one more comparative like this, that's called as quick ratio. The quick ratio, it's slightly similar but it's slightly different. Why? Because quick ratio checks how quickly you can convert your inventories into sales. What it means? It means how good you are in the sales process. That's it. Simple. So technically, we are not going on the fourth, we are going on the fifth, but I'll say the fourth only. Why? Because the quick ratio is not here, so I just explain you that one. So next is promoter shareholding. Many people may ignore this, but I'll suggest if you're going to the new company, or if the company is not recognized or not in the, let's say, top 50 or 100 company in your specific exchange or something, so please do refer to promoter shareholding, because it's all about the percentage of shares held by the company's promoters or founders. Obviously means the owner of the company, technically. Okay, many people they will be lying like, we are just a promoters, but technically you are owner, you are a decision maker. A shareholding above 51% suggests that the promoter have a controlling stake in the company. That's the reason many companies promoters, they don't want, like, their confidence going down, or even what do you call it, or their whatever the plans they have in their mind, they want to, if they want to execute it, they need to have more than 51%. So technically they are going to be controlling person, and it indicates confidence and commitment to its success. Because if, just imagine if there are companies and everyone holds 20, 20, 20, 20%, there are 5 owners, so what's wrong with it? Because everyone got equal, right? That's a good and bad. But let's say you believe in the Tata, and Tata just hold 5% of the company, and 95 is like hold by some other person who is not experienced in the running the firm, and even he is not good at selling stuff. What we need is sales. That's it. And promoters are always good for the confidence and commitment to its success. So let's go on. Next is all about earning yield. Earning yield compares company's earning per share to its market price per share. You can see in the formula. Simple. And earning yield greater than the 10 years government security means maybe anything, like maybe you can compare with straight away your treasury yield or anything, suggests that the company is earning of a higher return compared to low risk government securities. You might be wondering, whatever this guy is talking about, where we can find it. Okay, just to let you know, there are many screeners in all over the world for specific exchanges. or even the specific market condition. So for India specifically, you can go on the screener.in. So this is the screener.in. So where you'll find all the information and whatever you need it. That's it, simple. The next one, sales growth CAGR. What is CAGR? CAGR is compounded annual growth return, and sales growth CAGR is sales growth compounded annual growth return, that measures the annualized rate of growth of a company's sales over specified period. CAGR exceeding 15% for the last 7 to 10 years indicates strong and sustained revenue growth. Just to inform you one more thing, I mentioned in my last video that I might do the video with my favorite company called Radico Khaitan. You might be wondering why I'm not doing it now. Because that company just, the share price is just increasing day by day. Every week I'm looking at the share price and it's going up. So what I need is I need a stability in the share price, so the all the parameters and all the specific financial metrics, they're gonna be stable. At least for a couple of weeks I need a stability. The next one, self-sustainable growth rate. So just imagine what it represents. It represents the maximum growth rate a company can achieve using internally generated funds without relying on external financing. External financing can be debt, means bond, or straight away real debt from the banks, or maybe equity shareholding, or anything. They, how they are good in generating funds, means how they good are in the sales. It should be greater than the achieved sales growth rate to ensure sustainable growth rate. I'm talking here slightly faster, but just to let you know, it's very important. Why? Because if company is not self-sustainable, what it suggests us? They are just relying on the external funding. Simple, isn't it? The next one, the PE ratio. You might have heard about this many times. And honestly, let me tell you one thing. Here you may see 5 to 10, 12 means undervalued. It's false. The answer is depends on the industry, and that depends on what is your comparable companies and what you are using for. Obviously it's lower is better, but sometimes lower can be bankrupt type of firms as well, isn't it? So let me tell you, price to earning ratio compares a company's stock price to its earning per share. Means whatever your share price is, and what is your earning per share, how much you are earning per share. How you can find what is per share? So just divide market capital by number of shares, so you'll find it to what is share price for today. And if it's a listed company, obviously you have the share price, so just go and find the share price from the specific stock exchange or maybe your stockbroker, and divide by EPS. That's it. And with the lower values indicating potentially better value, but not always. That's reason I have started this YouTube channel, so I can give you better understanding whatever I have learned as of now. The next one, PE to growth. It's very famous formula. Many people use this. It's called PEG or PEG. That means whatever your PE, but what is your growth? PE to growth ratio compares a company's PE ratio to its earning growth rate. A PEG ratio below 1 indicates that the stock may be undervalued relative to its expected earning growth. Remember, this is used by very famous fund managers, and all over the world they use it for different purposes, for different studies and all those things, or even in the real life. But whenever it talks, it always talks about maybe, and that hits me very hard. Because if it's maybe, then why we are using it? We are using it to compare what is the currently growth and what is your P. Simple. Don't try to just buy with the P, or just don't try to buy with the PEG. You need a multiple specific financial metrics to analysis, and then you can decide what to do with it. Isn't it? Simple. The next one, the price to sales ratio. compares a company's market capitalization to its annual revenue. A ratio below 1.5, obviously that's gonna suggest your company's stock price is relatively low compared to its revenue, indicating potential undervaluation. And the formula is obviously below. The market capitalization divided by total sales is equal to price to sales. Many people, they ignore this formula because Ashwath Damodaran suggests there are some negative things about the price to sales, but he have suggested in other article that you can use it, but when you know the specific parameters and specific company or the organization why you are valuing for. The next one, 11th, isn't it? We are done with 10 or 11 now. The profitability net profit margin. What is it? Net profit margin measures the percentage of revenue that translates into the profit after accounting for all expenses and taxes. And net profit margin exceeding 8% indicates strong profitability. And why I have mentioned the three different formulas here, because many people, they may get they might misinterpret the different type of profit margins and all those things. So that's the reason I purposely have used this specific formula sheet here, that gross profit margin is different, operating profit margin is different, and net profit margin is different. But what is common in between? The divider. So net sales is common. What you change is just the name: gross profit, operating, net income. That's it, simple, into 100. Easy peasy. So next one is price to book ratio, that compares company's market capitalization to its book value. What is book value? Book value of the company is whatever the value of the company when they booked it. So total assets minus intangible assets and the liability. That's your book value. Okay? A ratio below 1 suggests that the stock may be undervalued related to its assets. But sometimes you need to consider what they are talking as assets. Is this intangible? Is it tangible? Or are they talking about the real assets? Or are they just talking about the imaginary numbers which are not real in the world? So always remember, market capitalization is fine. I'm not worried about the market capitalization. Mostly I'm worried about is the book value of equity. So go ahead and do the research. Then you'll get price to book ratio. Wow, this one always scares me, the free cash flow. Before starting with free cash flow, let me tell you, the free cash flow has two different versions. One is free cash flow to firm and free cash flow to equity. When we talk about firm, that means we are talking about the company who has a mix of both, like debt and equity. But when we talk about the free cash flow to equity, it's just equity. So when we calculate it, the formula is slightly different. I have used the simplest formula for it, but I'll suggest do refer Ashwath Damodaran or just comment me if you are looking for formula. I'll help you with it. No worries about it. What is free cash flow to firm? It represents the cash generated by company after accounting for capital expenditure. A positive FCF or CFO indicates that companies generates more cash than it consumes, which is positive sign for financial health, isn't it? It's always positive when they are going to talk about company generate more cash than it consumes. That's slightly similar we have seen in the sustainable growth, that how much companies can generate a cash and they are going to sustain. The dividend yield. The dividend yield measures the annual dividend income as a percentage of the stock current market price. A positive dividend yield indicates that the company pays dividend to its shareholders. But do you know one thing? When company can pay the shareholder dividend? When means unless and until they are in the profit, they can't pay single penny to shareholders. So make sure if company is paying dividend, that means company is in the profit technically. So let's go ahead. What is next one? Sure. It's my favorite formula. I'm using this from 2017 for sure. Altman Z score. And what is Altman Z means? It's just that Altman is the name of the guy who invented this formula. I got a chance to connect with his one of student. He has done his full PhD under or with Altman. So, and this formula is all about company's financial health and the likelihood of bankruptcy. I love this formula. A score below 2.5 suggests that the company is in the good financial health. But before going ahead, what I have done is I have added the snapshot of what Altman Z's model exactly suggests. What they suggest is if company's Altman Z score is below 1.8, that means something wrong. It's in the distress. It's what is distress? Distress means bankruptcy or something like this. And when it's a gray zone, it's in between 1.8 to 3. But when it's a safe zone, it's 3 to 4. But then why I'm suggesting to use 2.5 or above? Because it's very rare to find companies with 3 and above. So better, um, I suggest, or my mentor suggests us to negotiate little bit with the formula, because this formula is quite complex and uses multiple things to calculate. Piotrowski scores. It's little bit, I'll say it's all about the growth. Piotrowski score, and it's is a composite score that evaluates various financial metrics to assess the fundamental strength of company, and a score above 5 indicates strong fundamental performance, isn't it? But I don't suggest 5. I suggest at least 7 or above, unless and until company is very strong and in the stable market. Go for below score like 5 or 6. But if company is in the growth phase or something, at least go for 7 and above, at least. All right, next one. What is the next one? Oh, you might be wondering, what is it? It's credit rating. Simple. You might have heard about different credit agencies, and depends on the country you are living, most likely maybe UK or India or maybe all over the world, wherever you are. So every individual, we do have like some scores, like credit score, maybe a CIBIL, TransUnion, or maybe Experian or anything. So same for companies, they do have it. And what it does, it assesses the credit worthiness of company based on its ability to meet financial obligations. Just like normal, like us, if you're earning, let's say, £5,000 or maybe 5,000 Indian rupees, so it's gonna show you how much your financial worthiness is, and how good you can, or how based on your earnings, what is your ability to meet financial whatever your obligations are. Historically, it says BBB negative, means triple B negative and above, with the current credit rating being at least BB negative, indicates the relatively low credit risk. But what I'll say is, you need to do the comparable analysis for this. Whoever the firm they are, like the comparables are for this company, this specific firm you are targeting for, you need to check their credit rating and your company's credit rating, whichever companies you are doing analysis for. And simple, what it is, whichever is the higher is always better. That's it. So you might wondering what next. I told you I might use 20, 18 or something like this, but as of now we are done with 18 officially and one extra, which was quick ratio. But apart from this, I will say look at FII as well. What is FII? Is like foreign individual investors, or you can look at the foreign institutional investors. So that data is gonna suggest how many international investors are interested in that particular company. Okay, and thank you so much for tuning in. We, or specifically I, hope you found this video helpful in your journey towards financial success. The next one, once again, Don't forget to subscribe to my channel for more insightful content. And if you have any questions, any, like, it can be as simple or as basic as possible, or any topics you'd like to, like, you want me to cover or something, just feel free to leave them in the comment below. Until next time, happy investing. Thank you so much.